Trading profits versus volatility. In today's video, I'm going to talk to you about just that. How much profit do you actually want versus the amount of volatility that you're prepared to put up with? Because so many traders only focus on how much return they want to make, but don't look necessarily at the risk. Before I go any further, though, if you go to the link in the description today, I've put a link to our Trading for a Living report. It's a free report. You can go to that link, sign up for it. It does mean you come onto our email list as well, so you get notified when we're sending out videos and things like that. So you can sign up for that free Trading for a Living report there. Also, give us a like and a thumbs up, and please do subscribe to these videos because YouTube like that apparently. So yeah, please that way, appreciate that. Right. So one thing I always learned is, even when I was in the fund management industry many years ago, investors, even at investor level, they want the returns, but they don't want the to put up with the risks associated with it. So you're always trying to find this balance with investors. Same with my current funds. It's all very well trying to aim to make 100% in a year, but there's no point in doing that if I'm going to have a potential 30% drawdown, because investors probably won't like that. They all say they want that, they don't mind that at the beginning until they're 29% down on their investment and then they don't like it. So you have to find that fine line, and it's the same with you as an individual trader. Let me give you an example here. So I've just brought up our AI software here. It's a bit scrunched up because of fitting it into the window that I'm actually doing the recording off of. But anyway, so I've just created a back test here using the DST as the engine for this. And what we can do with the AI is that I can do back tests on and multiple variables based on my attitude to risk. So this one is still risking like 1% per trade, but it takes a lot of trades, and it's more aggressive in its overall nature. So it's coming up with an annualized return of 284%. Wow, you might say, I'll have some of that. Well, yes, that's fine, but there are other factors at play here, such as the drawdown levels. There you go, 30% drawdown, volatility, 56%. Now the reality is that volatility, what that would equate to is around about, because normally it's about half that in reality using the system. So whatever the system comes up with, you can pretty much halve it. Halving that comes out at around about 28% volatility, which is around about on during the course of a year. That means on average, one day a year you will have a 10% loss across a number of trades. So again, you might say, oh, actually, yeah, do I want to have 10% loss in a single day? It's an event that should only happen once a year, but you have to be prepared for that. And so therefore, you may want that return, but are you prepared to put up with that volatility to get that type of return, and obviously the drawdown in order to try and get that return as well? So therefore, there's no point in trying to make 300% in a year if you're not willing to put your £40,000 in your trading account and be willing for that £40,000 to maybe go down to £25,000 at some point. Now, it's not to say that drawdown, that's the longest drawdown over the last 10 years, so of 30%, but that could happen at any time. And it doesn't mean to say that it's going to be a maximum drawdown in the future. Of course, it might be 31% in the future, for example. So this sort of data helps you to say, yeah, do you know what? I need to understand who I am as a trader, because there's no point in having a super aggressive version here which all sounds fantastic, and then you not being comfortable with the volatility or a potential drawdown. The nice thing with using a system like this is you can tailor make it to how you are. So for example, I can now go back and say, well, what I'll actually do is I'll adjust that risk. I'll make it I'll adjust the risk down to a dynamic risk. Then I'm going to do a retest, and then so I'll hit test on the strategy and I'll press pause, and then it's just getting ready now. So it's just done doing its test. It only takes 20, 30 seconds to do a full test over 10 years, but then at least I can demonstrate to you how, there we go. So if I scroll down now, all I've done is I've reduced the risk down. So now it's brought the annualized return down to 86%, but with much lower drawdown levels and much lower volatility. So that's just a prime example of how you can use the power of computing to give you a way of trading which is suited to your aggression levels. So don't always think that I've got to go for 100% a year or 300% a year in this example. You need to make sure you understand who you are as a trader. What am I comfortable with as a trader as far as drawdowns? What is comfortable for one trader is not comfortable for another. And so many traders I see get this wrong, that they end up trading at levels. For example, you get a trader trading with 1% risk and you think, well, that's fine. But if they're not comfortable with that, they go and have two losers in a row, and then they don't want to take the next trade. So they need to be probably trading at, for argument's sake, 0.5% risk per trade, and so on and so forth. Everybody is different. So just some food for thought this week. Risk and returns, they are intrinsically linked. Hopefully this video is of use to you. I'll see you at the end of the week.